Welcome back to Investing Talk podcast. Today, we're tackling a question that's really been buzzing across financial headlines. Is Opendoor Technologies a good time to buy now? I mean, we've seen some pretty astonishing numbers from Opendoor recently, right? The stock rocketed nearly 40% in just one day, and it's boasting a staggering, 215% gains so far this year. But, with that kind of surge, traders and investors are split. Is this the rise of a true real estate disruptor, or is it just another meme-fueled frenzy that's waiting to fade? We're going to try and help you understand the core arguments, the risks involved, and of course, the potential rewards. Before we jump into the details, please remember to subscribe, like, and comment on this discussion. Your support really helps us bring you more analyses like this one. And hey, if you're finding value in what we do, maybe consider buying us a coffee. Also, if there's a specific company you'd like us to look into, please do leave a comment below. We love getting those suggestions. Okay, so let's unpack this incredible surge. Opendoor Technologies has truly captured Wall Street's attention. What was it, August 25th, 2025? Yeah, the stock closed at $5.01 after jumping nearly 40% in just one trading session. And year to date, up a whopping 215%. So the big question is, what's really behind such explosive growth? Is this, a sustainable trend or something? Well, something more speculative.
Well, what's fascinating here is that the rally isn't just one single thing. It's actually a mix of some pretty powerful factors all hitting at once. We're definitely seeing meme stock enthusiasm playing a role, significant leadership changes within the company too. Plus, there's a strong push towards AI integration, and you've even got some, let's say, favorable macroeconomic tailwinds helping out. Investors are clearly energized, by this idea that Opendoor might be transforming itself, moving away from being seen as just a risky iBuyer into potentially a tech-powered marketplace for homes. It's quite the narrative shift.
Okay, let's dive into that meme stock aspect because it feels like a huge part of Opendoor's story right now. I heard back in July, a hedge fund manager, Eric Jackson, publicly revealed a major stake. And he suggested the price could just skyrocket.
That's right. And that kind of bold claim, well, it immediately grabbed attention, especially among retail investors. The ones active on social platforms like Reddit and X. They picked up on it fast.
And here's where it gets really interesting, right? That combination of social media hype and maybe some coordinated buying, it pushed the stock up by nearly 370% within weeks. It really highlights how these retail communities can influence markets so dramatically.
Indeed. And you see this pattern. Many retail investors, they're drawn to these turnaround stories. They see Opendoor as maybe a cult stock with potential for those outsized gains. Anthony Pompliano even argues that this isn't just, pure speculation. He sees it as part of a broader cultural trend.
How so?
He thinks retail investors are acting almost like a decentralized hedge fund, loosely collaborating to spot opportunities and even push for company improvements.
Interesting take.
But, not everyone buys that. Others, like Eric Gordon over at the University of Michigan, he remains pretty skeptical. He describes Opendoor as a classic meme stock, basically suggesting these kinds of rallies, however exciting, are unlikely to last long term. So there's real tension there.
Right, the classic fundamentals versus sentiment debate. Okay, so beyond the retail frenzy, there was significant internal news too, like mid-August 2025. CEO Carrie Wheeler resigned. That came after some criticism from investors looking for strategic changes, yeah?
That's correct. And the market clearly saw her departure as a positive signal, a sign of potential transformation, maybe a renewed focus. There was a palpable reaction.
And taking the helm as interim CEO is Srisha Radhakrishna. He was the chief technology and product officer before this, comes with a background at Google, co-founded an AI startup, so definitely brings a tech-forward perspective to Opendoor.
Yes, and if we connect this to the bigger picture, this leadership transition is really key to understanding the company's new direction. It's not just musical chairs. Under Radhakrishna's guidance, Opendoor is actively pivoting, moving away from directly flipping homes. That's the iBuying model, which is very capital intensive. And they're moving toward an asset-light marketplace model instead.
Okay, so less about owning the houses themselves.
Exactly. The goal is to act more like a platform, a real estate marketplace, connecting buyers and sellers, earning referral fees. This pivot, if successful, aims to reduce operational risk, definitely lower capital requirements, and hopefully improve profit margins over time. It's aligning the company more with, say, tech platforms than traditional home flipping businesses. It's a pretty fundamental shift.
Okay, let's unpack this AI factor further because that seems central to the new vision. A major part of Opendoor's strategy now involves integrating generative AI. Radhakrishna himself said his view on AI has shifted, right? He thinks it can do way more than we think.
He did. And the plan is to use AI for some really crucial tasks. Things like pricing homes more accurately, tailoring marketing for listings, maybe even helping with in-home assessments. It certainly positions Opendoor as a modern, innovation-focused player, and that definitely appeals to growth-oriented investors.
But it does raise that important question. How realistic is this AI ambition, especially in real estate?
That's the key question, isn't it? Experts do caution that AI adoption in real estate, particularly for the hands-on stuff, is still pretty experimental. I mean, sure, AI can undoubtedly assist with data analysis, predictive modeling, great for that. But tasks like home inspections, those still require a level of judgment, nuance, that algorithms might not fully replicate just yet.
Right.
Eric Gordon, the professor we mentioned earlier, he finds the idea of AI doing all home inspections kind of humorous. He asks, how does an AI tell if an attic leaks? Or smell mold? Or know if the fridge is about to die?
That's a fantastic point. It really highlights that gap between like the slick tech promise and the messy reality of physical property.
Precisely. So while it's exciting, this transition to an AI-driven asset-light model is definitely ambitious. It adds both potential and, frankly, a lot of uncertainty.
Okay, so with all this excitement, the leadership change, the AI push, what are Wall Street analysts actually saying? It sounds like opinions are pretty mixed.
Oh, they certainly are. Conflicted might be an understatement, actually.
Uh,
According to TipRanks, you look at the average 12-month price target, and it's barely above $1. That suggests a potential downside of, nearly 80% from current levels.
wow, 80% downside.
Yeah, and analysts on TipRanks lean towards a moderate sell. But then you look at public.com, and it shows a much more optimistic projection, around $20.73, though it seems that's based more on broader expectations rather than, deep conviction. Their consensus rating is just hold.
That is a massive gap between forecasts. What's driving such different views?
Well, it really boils down to a few key concerns versus some hopeful factors. On the concern side, analysts worry about the stock's volatility, heavily influenced by social media buzz. That makes forecasting tough.
Makes sense.
Then there are the very real business risks tied to this big pivot away from iBuying. It's complex, execution is everything, and it's not guaranteed to work. And there's that potential for AI overpromises if the tech doesn't deliver practical results as quickly or effectively as hoped. Gordon's skepticism touches on that.
Okay, so those are the worries. What about the supportive factors?
There are some hints of potential interest rate cuts later on, for example, that could lift speculative names like Opendoor. Lower rates generally make borrowing cheaper, can encourage housing activity, and make future growth stories look more attractive.
Right.
Plus, the general investor appetite for tech-driven growth companies, that remains pretty strong overall. So that provides some underlying momentum. It's a real mix.
So what are the primary risks, the main red flags you think people should consider if they're looking at Opendoor Technologies right now?
Several stand out. First, definitely the stock's price being so heavily influenced by retail investor hype. That can evaporate quickly, as we know. High volatility is a given.
Yeah, the meme factor. Second, the AI strategy. It's promising, sure, but still very early stages. It's largely untested for practical effectiveness in tricky areas like home inspections. Big execution risk there. Third, the actual transition to an asset-light marketplace. It's complex, logistically and operationally. Success isn't guaranteed. And beyond strategy, you have to look at the financials. Persistent net losses, negative free cash flow, they're still burning cash. And significant debt. What is it, about $4.8 billion in debt versus only $1.2 billion in cash? That's a heavy load. Also worth noting, there has been some insider selling by executives. That doesn't always mean disaster, but it's something to be aware of. And lastly, don't forget external factors. The housing market itself, interest rate shifts, potential regulatory changes, any of those could hit performance hard, regardless of Opendoor's plans.
Okay, that's a lot to weigh. To round out the picture, let's quickly touch on some fundamental and technical aspects. What are the numbers telling us? Sure. Fundamentally, Opendoor's full year 2024 revenues were around $13.7 billion. There's actually a decline from previous years, and they posted a net loss of roughly $420 million.
Still losing money then?
Yes.
Oh.
And while their liquidity, their cash on hand, is considered okay for the next 12 months or so, free cash flow is still negative. So cash is going out the door faster than it's coming in from operations. The company currently trades below its book value. The price-to-book ratio is around 0.8x.
Which sometimes signals value, but
But here, it's heavily influenced by the fact they aren't profitable. So a standard PE ratio, price to earnings, isn't really meaningful because there are no earnings to measure against.
got it. And technically, what are the charts saying after that big spike?
Well, technically, despite those huge jumps recently, the stock's actually traded in a range between about $1.65 and $2.40 over the last month. And importantly, it remains below its 50-day and 200-day moving averages. That typically suggests the longer-term downtrend is still intact, even with these short, sharp rallies. And volatility, well, no surprise, it remains extremely elevated. The price swings are very much news-driven right now.
Okay, so putting it all together, the hype, the pivot, the AI dreams, the mixed analyst views, the financials, what does this all mean for you, the investor, looking at Opendoor now?
Look, Opendoor Technologies clearly represents a high-risk, high-reward kind of opportunity. There's no getting around that. Its recent stock surge is really a testament to the power of retail enthusiasm, yes, but also those significant leadership changes and the company's very ambitious tech goals. For long-term investors, I mean, the company's success really hinges entirely on its ability to execute this AI pivot and the marketplace strategy effectively. Can they actually make it work and turn profitable? That's the question. For short-term traders, well, the volatility presents both potential for quick gains and, just as easily, significant pitfalls. You have to be prepared for wild swings.
So caution is key.
Absolutely. Investors should approach with caution, really carefully weighing the speculative nature of this rally against the company's big strategic ambitions and, the current market realities and those financial figures we talked about. Analysts are generally saying hold, which, let's be honest, often indicates notable risks and uncertainty ahead.
So what does this all mean? Opendoor Technologies is just a fascinating case study, isn't it? A company right at a crossroads. It's navigating a really volatile market with some incredibly ambitious plans, fueled by both traditional forces and these newer retail dynamics.
Exactly. And maybe the provocative thought to leave folks with is this. How will that delicate balance play out? You've got the retail investor fervor on one side, you've got this unproven AI strategy, and then you have these shifting macroeconomic conditions, like interest rates. How will all that ultimately shape Opendoor's future? And maybe more broadly, what does this specific stock's journey tell us about the evolving dynamics of modern investing itself, where sometimes sentiment, buzz, social media seem to outweigh the fundamentals, at least for a while? It really makes you question what drives value today.
A lot to think about, as always. Thank you for joining us for this really insightful discussion. We hope this conversation has provided you with some valuable insights. Don't forget to subscribe, like, and leave a comment. Tell us what you think, or maybe let us know what company we should review next. And if you're feeling generous, hey, consider buying us a coffee. The link is usually somewhere below. Until next time, happy investing.